here's where we pivot a bit and look at what's happening in the U.S. demand-wise, storage-wise, what's going to happen with products. And just would like to remind you, please like, share, subscribe. We remain bullish on the diesel side. That's something that has been the case, remains the case. We think gasoline will start to see some of those builds, especially along seasonal norms, while jet fuel, not too much to write home about one way or the other. But one of the bigger things that we keep looking at and looking for is propane. Propane still remains in a fairly tight spot. We've seen pricing come down a bit. Some demand abroad has slowed, and that's more driven by congestion at the Panama Canal. The Panama Canal has given preferential treatment to LNG and container ships, and that's kicked LPG to the back of the line, which that issue is pushing India, China to go, and Asia in general to go a bit more to the Middle East, which again, there's still going to be demand for it, especially because if they buy more from the Middle East, that means that Middle East will have less to sell into other markets, well back into those markets. So those are just going to be some of those shifting miles per ton that we've been talking about. At least for clients. I don't think we've talked too much about miles per ton on the shows. So then when we look at what are the underlying backdrop, here you can see that the current demand was 15.522 million barrels a day of product supplied. And last week it was 15.43. We should see a spike up in gasoline, a little bit of a decline in diesel. So we'll see some of those shifts. Again, I think the gasoline increase will be offset by the diesel decline, or disti decline, I should say. And when you look at the average, with the average sitting at about 15.3, when you look at the historically going back through 17, 18, and 19, you can see that we're just below where those were. And this is where I just think we're going to follow some of these seasonal norms and see that move down post-Thanksgiving. It'll just be slightly below where we were. Because when you look at those last 3 years, you can see that we hover right around 15.1, which is why I just think we'll be at that 14.9, if you will, 14.8, 14.9, as we're just below that normal. And then you get those increases into year end for the holiday season, so for Christmas, for New Year's. So again, I just think it'll be normal seasonal moves, just at a slight step down from that normal, which we will continue to see happen as we get through Thanksgiving. Then when we look at distillate had a draw of 830,000 barrels. That's 6.9 million below the 5-year average. But when you look at where is that driven by? Well, PAD 1 is 10.3 million below the 5-year average. To give you an idea of where that shortfall is, PAD 2 through PAD 5 are right in line with the 5-year. That's where, again, trying to get that PAD 3 product onto the Colonial into PAD 1, and that's keeping imports elevated. Even though imports were down 40,000 barrels a day, that's still above the 5-year average, all really being driven by what we're seeing into PAD 1. And we're going to continue to see PAD 1 be that bright spot when we're thinking about where is some of this product going, how is it moving into the system. And when we look at production, so production of distillate was down about 25,000 barrels a day. That's 23 basis points. Which again, gasoline was then down 74,000 barrels a day, or 61 basis points. We just expect to see that step up. And just when you're thinking about where do we see, it's when you're looking at distillate cut will move closer to 32%, and that will drive the gasoline side. They'll try to keep it as close to 60, just at 63%. But again, that's where we're going to see some of these balancing acts as they really ramp up for the heating oil side, because that is a very important metric as we go into the into peak winter season. And that, as we were saying last week, we expected demand to stay just above that 5-year average as we had that spike. We thought there might have been a slight move down, just again moving with the 5-year average. Instead, it had one more tick up. Now we expect to see this drop, but again, it's a seasonal drop because Thanksgiving happens. You move everything into place ahead of Thanksgiving. So we just expect it to follow the 5-year average, still remain above it, but moving in that direction as we go through this week into next week. And then when you look at trucking demand is fairly flat, sitting there at 115. Based on what we expect to see this increase a bit, but again, not a huge increase, just staying within this fairly tight range, as we have load availability still remaining elevated, but still marrying quite nicely. But the issue that we continue to see, and we'll talk more about this in the Econ Show, is the issue, and we talked about it last week in the Econ Show, the difference between short haul, last mile, and going across on the long haul side. Long haul still finding a huge issue for labor. People don't want it. Prices aren't there. And by prices, I mean wages. This is where we're seeing some of these pressure points. And that's why where you look at rates still remain elevated, but diesel prices continue to trend higher, which is something that we've been talking about and very concerned about. And we'll talk about why about that in a few more minutes. Then when you look at U.S. rail traffic, so when we look at rail traffic, it's up 1.7% versus 2020. But when you look at what is driving that, obviously coal is going to remain the bright spot. Grains have come down a touch, but still will remain elevated. Again, 2019, tough comp year for grains. Motor vehicle getting better, but still not where it was in 2020. And again, it's just those shortfalls that remain. And then when we look at petroleum and petroleum products, a little bit of an increase. Again, that's going to be a matter of how do you get it from pad 3 into pad 1. But intermodal continuing to worsen. Now it's down 9.7% versus this week in 2020. Again, tougher comps, but you're just seeing just the pressure, the congestion, those issues in terms of increasing that intermodal as total traffic declines slightly. But again, 2020 was a big year, and we'll talk about the Cass Index in the Economy Show later today. And then when we look at the ports for the front month still remains very congested, but things get a little bit better into the end of November. But remember, there's usually that kickback kickback's probably a wrong term, this kick out in terms of where the loadings happen, because again, Thanksgiving is right around the corner. So typically you see that drop in Thanksgiving, and then you see that spike in post-Thanksgiving, and that is playing out here. So even though we're seeing this drop, you see it recover quickly, and that's just getting some of that shift for the Thanksgiving season. Now, when we look at the heating demand is ticking up a little bit, but when you look at near normal, below normal, we're getting right into this where you could see a little bit cooler weather pulling some of that through. That's really from the Midwest over into the East Coast, but you see things are a bit above normal from Texas over into California and up into Montana. So even though we'll see an increase in demand on pad 1, see a little bit of a normalization in the Midwest and in the South and West Coast, still net positive, because this is where obviously on pad 1 is where the most heating oil is consumed, natural gas for heating. So that'll be a net positive, but still slight deviations, nothing too aggressive in terms of a huge cold spell. Then when we look at what has happened in gasoline, one thing that I also wanted to mention before we move on is, and I pulled this down because I think it's important. So road diesel versus heating oil. So remember in 2012, New York became the first state to require ultra low sulfur heating oil, which is heating oil sulfur content of 15 parts per million or less. Then you had Delaware and New Jersey transfer to that in 16. And then as we talked about in 2018, you had 6 New England states also adopt this, which is why we talk so much about the competition between heating oil and road diesel. So again, these are some of those key components when you think about some of this pricing, and we'll talk about that more in a minute. Gasoline had a draw of 710,000 barrels. You can see that the draw brings us 9.3 million below the 5-year average. When you look at where is that being driven by, pad 1 is 4.6 million below the 5-year average, and pad 2 is 3.2 million, while pad 3, pad 4, pad 5 is fairly in line. We had a little bit of an increase in imports by 237,000 barrels a day. That was driven by pad 1, which increased 199,000 barrels a day. Now, for those that watched last week, we expected to see a little bit of a bounce from 550, but not too much, and now we expect to see that drop back down. It's still 267,000 above the 5-year average, but based on what we're seeing, what's in the water, what's in the future, just based on what has been consigned so far, we'll continue to see that ramp down. It's still elevated given this time of year, but we expect it to move much closer to the 5-year average, and that'll be driven by Pad 1 seeing some of those reductions in general. So then when we look at gasoline demand ticked a little bit higher. According to Gas Buddy data, weekly Sunday to Saturday, U.S. gasoline demand rose 0.2% from the prior week and was 0.5% higher than the rolling 4-week average. So again, right within this, this flatlining that we've been talking about, and then we'll get that nice little pop into Thanksgiving, and then we expect to see that drop off a bit as we come out of Thanksgiving. Then when you look at gasoline usage is projected to fall to about 9.17 million barrels a day based on Descartes. Again, just fairly right in line with kind of that 9.1, 9.2. So those are some of the different components overall. Then when we look at what is happening on pricing, as we were saying and agreeing with Gas Buddy, we expected to see a decline in gas prices. So we went from over $3.40 to just under $3.40. And we expect that to creep back down by about a penny or two over the next week. But on the flip side, diesel still continues to grind higher, now getting much closer to $3.74. That's something when you look at the competition, again, between heating oil, road diesel, that's going to remain elevated. We're still in a fairly tight spot, and diesel is going to continue to be the strong point at this point in time. Now looking at the Gas Buddy data survey, high gas prices impacting travel plans in 2021, 51% are saying yes. Then when you look at just before we go into what Gas Buddy is seeing, AAA predicts 53.4 million Americans will travel for the Thanksgiving holiday. That is up 13% from 2020 and just down 5% versus 2019. So getting closer to some of those averages. But that's when you look at AAA. Now let's look at what Gas Buddy is saying. So fewer drivers this Thanksgiving than during height of pandemic. So this point, 68% of Americans not traveling for Thanksgiving weekend. 51% said the reason is because of the high gas prices. Again, these are just surveys. Who are you surveying? How is it skewed? How big is your sample set? So it essentially just confirms that we're going to be below where we were in 2019. It's just going to be a matter of how far below 2019, because 2020, we should be a little bit higher. I think some of this is picking up as people are going to be traveling not as far. So they'll still be traveling, but at a shorter distance, not staying over, more day trips. So I think that's going to be something to watch as we get closer to that point in time. When you look at DOE blending components, they flatlined a bit. So when blending components were down 50,000 barrels, that's just 1.6 million below the 5-year average. As we were saying, we expected this to flatline and now start to creep higher. And just fall fairly much in line with what was normal in 2019, in 2016, and in again 2018. We don't see this deviating all that much, just given the underlying backdrop of gasoline and the other products. Then when you look at products supplied, again, going back to the last 15 years, flatlining. We expected to see a little bit of an increase. Instead, it went flat, which just means that next week we expect to see reporting an increase, and then again that decline as we go forward. And here's where you can typically see on a seasonal basis. So zooming in a bit over the last 5, from 16 to 19. You can see that there's usually this spike up this time of year, and then there's a big drop. Instead, the timing of that spike will be a little bit later. So we will get that spike up in 2021 and then the spike down. It's just a matter of timing. It'll come this week instead of last week, which then will look better just given versus historics, but still just a matter of timing as to when it happens, which we think it'll be offset by a decline in diesel when we're looking holistically at demand. Residential occupancy, when you think about working from home, has ticked a little bit higher. Workplace activity has come down a touch with transit, while everything else remains fairly stable. Then when you look at Apple trends, again, just moving closer to that seasonal norm. And remember, this is comparing versus January of 2020, not versus 2019, just because I think there was some confusion, but still fairly robust over that time period. Then when you look at propane had a small draw of 190,000 barrels, which brings us 11.1 million below the 5-year average, and it's all driven by Pad 3. Pad 3 had a decline, is below 12.3 million below. that 5-year average as exports remain elevated. You can see that we're still above where we were in 2017, but we're flatlining just at the same time, and we expect to see those declines accelerate, especially as things get colder in the U.S. That will again pull down more product in storage, and that will keep days of supply moving in that direction that is seasonally normal, just at the lower end of that rate. Vaccinations continue to trend up. I think this is not, and this is never going to be a political show, but it's a matter of, well, you have vaccinations continuing to trend higher, but yet you have COVID continuing to trend up. And so that could be one argument. And then the counter argument is, well, even though you have, if you have cases going up, you're not seeing the same increase in hospitalizations, decreasing the stress on the supply chain, and again, keeping things fairly normal. But we continue to see a fairly strong move. And again, just gradual as we get to these peak rates, you're starting to see them level off. Now, on the jet fuel side, as we've been talking about, we didn't expect to see a huge increase from the lifting and adjusting of international travel. When you look at what the builds in jet fuel, it was just 90,000 barrels. It's 2.1 million below the 5-year average, nothing too crazy. We expected a little bit of a normalization, closer to about 1.4. You can see it's just coming down to the low end of that level. But when you look at seasonally, we typically get a seasonal drop and then a bounce. We expect that to happen again. It's just that bounce is going to be below where these other points were. And you can see that pivot point, it varies based on where are we in the shipping cycle, where are we in terms of pulling in more jet fuel, more activity. And again, Thanksgiving is a huge travel period. So we do expect an increase in TSA passengers. We expect an increase in jet fuel demand. It's just going to be seasonally underwhelming when you compare it to what is normal going back over the last several years. And then on a global level, it continues to disappoint a bit as we get Europe and Asia Pacific weakening. The average number of departures per day decreased by just under 1.7% week on week. Year on year, departures were up by about 30%, but departures in Australia led growth, while departures in China declined again by 300, a slower decline than in previous weeks, but still a decline as they continue to essentially slow down travel to mitigate against the spread of COVID. Globally, the passenger flight schedule for the 11 weeks ahead declined again by 0.5% week on week. In Europe, departures in the Eurocontrol area fell by 3.5% week on week. Spain and Germany registered the largest declines. U.S. passenger numbers increased by 2.5% as, again, that increased some of that flow on the international side. Asia Pacific departures continued to crater in China again for the second week as flight activity bounced in Australia, India, and South Korea. And then just honing in on China for a moment, according to Airportia data, the number of flights kept dropping sharply below 2020 levels, down almost 50% year on year, which again just confirms the restrictions and how that has impacted demand. TSA passengers, the high end is ticking a little bit higher, but when you look at that lower end, we continue to be in this fairly tight range. And then when you look at this week and especially next week going forward, when you look at 2019, that lower end essentially drops off because people travel, people try and just based on fear of, or for anyone who's tried to fly, understands the pain that has existed for traveling. We do expect travel to start a little bit earlier, especially because more people are working from home. You can work from home at your house or at your in-laws or at your parents. So you could see some of that travel pulled forward a bit. So we do expect this to be a bounce and again, just be in line with 2019 in terms of movement, but just the pace will be below what is normal, but still move seasonally. Then when we look at OpenTable restaurant data has gotten a little bit better, which is a net positive. You can see that people have celebrated Veterans Day. And then you had some fairly stable moves through the weekend as the weekdays still remain, about 10 to 15% off of normal, and then things remaining about 5% on average better than normal on the weekend. So again, we continue to see this fairly stable over time. And now in the next segment, we're going to turn abroad, look at what's happening with U.S. exports and how is that marrying with what is happening in the international markets.